please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to CNBC TV18's Citizens Monetary Policy Committee meeting. This committee meets traditionally on the eve of the monetary policy to discuss what the official monetary policy should be debating about and deciding on. We are meeting in interesting times. We have a trade tit for tat that's going on in global markets. Oil prices have spiked separately, and of course within India we have some worries over the banking sector and its ability to lend in the coming months. Joining me today to discuss what the monetary policy has to discuss are our own members, Dr. Pronab Sen, former advisor to the Planning Commission, chairman of our Monetary Policy Committee, Sajjid Chinoy of JP Morgan, Samiran Chakraborty of Citi, Sonal Varma of Nomura Financial Advisory, and Kanti Ghosh, the Chief Economic Advisor at State Bank of India. Gentlemen and lady, thank you very much for joining us. Well, since there's so much to discuss, straight away to the chairman. Dr. Sen, first the external environment, sir, especially the trade tit for tat. How should that be parsed by the Monetary Policy Committee?
Well, it's not a tit for tat yet. There's a lot of saber rattling going on, but it may well come. This is the thing. What has happened is a huge amount of uncertainty. The other thing that has happened is that the dispute resolution mechanism of the WTO is coming under fire. Now, none of this is good news. Now, the real question is that what's going to happen in terms of, and what can the monetary system do about it? I think the first question that we need to ask is what's going to happen in the US. We know that duties have been raised. It's going to have a cost push effect. Inflation is going to inch up. Will the US Fed actually have even more aggressive rate hikes than had been planned? That's a possibility which one really needs to keep a weather out for. The second is the fact that the stock markets around the world have crashed and continue to be extremely jittery. Now, in a situation like that, we do not know where the liquidity is going to be flowing to. What's going to happen with that? Then, of course, you have the big problem, which is that if it comes to, in fact, a trade war, then we are looking at countries across the world facing the prospect of slowdown, and in a situation where there is practically no room for monetary easing, except in countries like India. So it's a difficult period.
Soumya, markets, from the previous policy to the upcoming policy in the first week of April, what have been the changes to the market's mood, the fixed income market and in the FX market?
Since the last policy, when it was announced in announced in February, there has been a lot of changes in the domestic market and in the global market. The Fed has gone ahead with the rate hike, and as of now, if you look into the Fed statement, there's an 82% probability of a rate hike in June, and if that rate hike comes through, the rate hike in the next September could be at 51%. However, the good thing is that Fed is looking at a rate hike gradually and not at an exponential stage. So this is the important thing. However, the other aspect which we need to keep in mind regarding the Fed rate hike is that since the Fed is also controlling a loose fiscal policy. So if you look into the federal debt, that has actually now gone up to 21 trillion. The students' debt has gone up to 13 trillion. So at some point of time, the rate hikes which the Fed is saying, and that's the reason why I said that the gradual rate hikes the Fed is doing is going to take a hit. So my sense is that even though the Fed is pushing forward for a guidance for a rate hike of close to 3 in this year, 3 next year and 2 in the following year, I think still there is going to be some amount of adjustment given that the debt overhang in the system. Now, how does it impact the forex market and the fixed income market? As far as the forex market is concerned, I think the rupee in the last couple of days after the recent happenings in the financial market on the trade front, on the bank front, I think the rupee has behaved quite remarkably stable and possibly due to some sort of RBI intervention in the market. So that's the positive thing, and there is a feeling in the market that this around 80 to 100 billion of trade exposures which the banks have got could actually find some sort of an adjustment in the next 3 months. So therefore, the importers are not rushing into the market for covering their positions, and that's helping the rupee to stay stable. So in my sense, even though the bottom line is that even though the Fed has gone ahead with a rate hike, but at the same time, it is not having that amount of impact on the domestic forex market, at least for the time being. Possibly it could have an impact 2 to 3 months down the line if there is some amount of adjustment on the trade front.
Sonal, what would the inflation view, what should the inflation view be, considering that we got a surprisingly low food inflation number last time round?
I think, Lata, in the near term, clearly inflation has surprised a bit on the downside, mainly because of food prices coming off. But also, I think both in Jan and Feb, the momentum in core inflation has moderated. And our measures of underlying inflation are actually between 4–4.5%. So the headline core CPI of 5+ clearly exaggerates the underlying inflation. But despite the near-term inflation positive surprise, I think there are clearly upside risks. And the biggest risk stemming from the government's policy decision with respect to the minimum support prices. There still seems to be a lot of ambiguity with respect to the cost measure that will exactly be used and the potential impact that could have on future inflation. I think that is still a risk. We don't have clarity on this. We'll need to wait for another couple of months before we have a clarity on how this plays out. And second, the risks on account of oil prices moving up. So both those factors suggest that, yes, near-term inflation has moderated, but I think risks are still very much on the upside, particularly stemming from government policies around food inflation.
Okay, MSP and crude, of course. Okay, I would not normally have brought the growth picture into the discussion, but there was a stunning last sentence in the previous monetary policy, and I want to read that. The committee is of the view that the nascent recovery needs to be carefully nurtured and growth put on a sustainably higher path through conducive and stable macro-financial management. Samiran, clearly the committee is keeping the nascent growth on its radar, and that may have gotten a bit tough despite good commercial vehicle numbers and PMI numbers. There is a problem in the banking system because of the accelerated recognition of NPAs. So what should the MPC take on board with respect to growth concerns?
So it's a difficult policy from that perspective because the data which is out in public is showing not only a significant year-over-year improvement in most of the growth parameters, but also a sequential improvement on a seasonally adjusted month-on-month basis. So, but on the other hand, at least two big concerns have evolved over the last few days, which could have a meaningful bearing on the growth numbers. One is, as Dr. Sen discussed, the trade-related uncertainty. The other is related to the whole banking sector issue, where not just the issue of bank fraud, but also the issue of the IBC process itself not moving fast enough, and whether there is enough growth capital available to the banks after all this. So these two headwinds could mean that the sequential improvement that we have seen on growth could be much short-lived. And that's the risk that the committee will have to keep in mind. While I accept Sonal's point about some upside risk to inflation, similarly, there are downside risks to growth. So it's just the opposite, that the actual inflation number has been lower than expected, and the risks are to the upside. Actual growth numbers have been higher than expected, but the risks are to the downside.
Okay. Well, Sajjid, that's interesting. Now, how should the RBI and the MPC take on board the fact, and that cannot be ignored, that banks are not desiring to buy bonds now? Is that a factor that the MPC has to contend with? Although it's not its core mandate, but that's the reality.
I know, but I think the MPC has stuck to its mandate. I think that just should be the focus going forward, that the mandate has to be, it is a flexible inflation targeting approach. My first kind of call of duty is to keep inflation close to 4%. Subject to that realization, I should focus on where the output gap is. I think I want to pick up from where both Samiran and Sonal left off. I think a lot will depend on how forward-looking the MPC is. Because exactly as Samiran said, today you would think inflation is surprising to the downside, and the growth concerns that the MPC spoke about have alleviated because you had this one GDP print above 7%. Next quarter will also be above 7%. High frequency is doing well. But if you go 3-4 quarters down, what you see is inflation risks are very much skewed to the upside for two reasons. We haven't discussed the fact that oil is back at 70. And with Saudi Arabia saying what they did, this is much more supply than demand in the last week or so. So if your view is going to be oil is going to be close to 70 for the rest of this year, I think first the MPC has to market its own inflation forecast, which was predicated with oil at 55. The second is the food price increase that will come in the second half of the year because of any MSP increase. Both food and fuel have a critical bearing on inflation expectations. So later in this year, if you look at higher fuel prices, higher food prices because of the government's MSP policy, that will ultimately feed through into core inflation as well. So I think the first thing is how forward-looking is the MPC willing to be? Ignore the inflation prints for the next 4-5 months. Inflation will come all the way maybe down to 4%. The second quarter has got unfavorable base effects. Until September, you've got both GST and the HRA allowance distorting the year-on-year prints. The first clean number we'll get is going to be closer to October. So what I'll be looking at is what is the second half fiscal year inflation forecast for the RBI. If that number is 5 or thereabouts, I think then the MPC will get concerned because that's meaningfully higher than the 4%.
So you expect a change in the fan chart which the RBI will put out?
April is the full year review. That's when the RBI revisits all its assumptions on growth and inflation. With oil at 70 now, I would expect that number will be, that fan chart will be revised.
I think Sajjid and Sonal are pointing to inflation risks, whereas Samiran and Dr. Sen are pointing to the fact that there are growth risks both domestically as well as globally. Soumya, of course, pointing out that there is a debt overhang also, which the Fed will have to take into consideration. I'll take a very quick break. I'm back, and I'll be asking for what you would prescribe as what the economy needs at this point in time. Back in a jiffy. Welcome back. This is the Citizens Monetary Policy Committee meeting to discuss on the eve of the Reserve Bank's policy what are the factors that the committee ought to consider. Well, Dr. Sen, what should the doctor prescribe? There are, of course, dangers to growth, no two ways about it. E-way bill will start in April. That also is going to have its own disruption to growth. Nevertheless, the mandate is inflation and crude is at 70. What should the MPC do by way of action?
Well, you know, the fact is that you really can't go by looking simply at what the current price of crude is, because we are now in a world where the crude prices are going to yo-yo because the shale oil producers will be moving in and out of production depending upon how prices are behaving. So oil is going to be range bound, but it's going to move around, and I don't think we should get terribly worked up about its immediate short-run movement. So I wouldn't worry too much about that. Insofar as the upside risk to inflation is concerned, which is in terms of the MSP, again, I wouldn't worry too much about it. The fact of the matter is that the MSP is only as good as the government's ability to support that price. And the fact is that the institutional infrastructure is simply not there. You can announce any price you want, but the market is going to be doing exactly what it thinks it should be doing. It won't care about the MSP very much. So I don't think that is an immediate risk. It will become a risk if you know, the government's procurement infrastructure or the deficit payment arrangements become stronger. Then the ball game changes, but that's not happening in the next season. At the moment, I think the real issue is what's going to happen on the growth side, both for domestic reasons as well as for global reasons. So in this particular situation, I would probably be a little cautious, because as far as growth is concerned, you really don't have to be ahead of the curve. Inflation is a different ballgame. But on growth, you don't have to be ahead of the curve. So that's what we should be looking at.
Okay, caution. And actually, you know, come to think of it, Soumya, and I want to get you in on this. You know, although the 2-3 policies ago, the Reserve Bank cut after coming to neutral, bond yields have since gone higher. despite the last 2 weeks mellowing. And MCLR rates have been hiked by banks. So quite contrary to what the Reserve Bank did. How should the RBI tackle?
See, I think here there is actually the peculiar conundrums of the bond market. I'll just give you some numbers. For example, currently, if you look into the core liquidity in the banking system, which is basically the liquidity after adjust for the government cash balances, that has declined from a high of around 4 lakh crores in the beginning of this year to less than 1 lakh crore as of now, I think around 80,000 crore. And if you look into the repo numbers, the repo, all term repo and net it off of the reverse repo, including the term reverse repo, you will find that the system is already running at a deficit of around 50,000 crores. So my sense is that the system is running at a deficit. And the other important thing is that if you actually look into the spread between the 10-year yield and the repo rate, the spread is currently around more than 170 to 180 basis points on the old paper. Historically, the median spread between the two papers has been around 70 basis points. So I think there is an element of irrationality in the market. And the other important thing is that if we just juxtapose a calculation by looking into the demand supply maths of the bond market in the next year, you will find that even if you are assuming say a 10% growth in the bank's NDTL and assuming that the market shares of the banks, scheduled commercial banks, primary dealers, mutual funds remain at the same level which it was in this year, you will still find that there could be a deficit of close to 1.5 lakh crores in the banking system in terms of the papers to be absorbed by the market. So at some point of time, the RBI needs to seriously address this issue. How does it want to, whether it wants to inject liquidity, or whether it wants to do it through a permanent mode or other mode. Otherwise, what is going to happen is that the bond markets will stay at an elevated level, and at some point of time, it could have some amount of a negative impact on the market sentiments.
I take your point, though I don't know how the MPC will bring it. And even this 10% growth in NDTL, I don't know if that also will materialize. Sonal, so what should the MPC do? I mean, it's quite clear that there is a tightness, though I would assume that actually the liquidity tightness was not as much given the advance tax payout. There were people expecting 1.5 lakh crore of deficit. I think the deficit was lower than that. But that apart, do you think the MPC has to concentrate on the way in which prices might rise because of trade and because of crude? Or do you think now growth needs a helping hand? What should the tone be, for instance?
I think we are still in the zone where we're sort of in the wait and watch zone, I guess, right now. Clearly, there are risks to inflation, like I said, because of MSP and oil. And, one point with respect to Dr. Sen's point on the procurement infrastructure of the government not being there, that's very true. At the same time, the government is also trying to ensure that the MSP actually becomes an effective floor through some form of fiscal transfers to be made to farmers. So, like I said, I think government policies around food inflation are changing because there are, their politics clearly, and there's a lot at stake because of the election cycle. So I think we have to be cognizant of the upside risk that poses both to the inflation and the fiscal outlook. At the same time, like I said, I think underlying inflation as of now is between 4.5%. Growth has picked up, but there has been an effective tightening of lending standards, and the banking sector issues mean that whatever growth capital one had assumed back in October after the recapitalization has completely vanished. So there is a strong cyclical recovery. At the same time, there are concerns on the sustainability of this growth cycle. So I think at this stage, we are basically in a wait and watch, like I said, specifically with respect to government policy on MSP. If that is substantially high, then despite the adverse growth impact we are seeing, if that triggers huge second round effects, leads to higher core inflation, leads to higher inflation expectations in the backdrop of what's happening globally in terms of risk and domestically with respect to perception around the macro risks in India, I think that would trigger, some response. But at this stage, it is a wait and watch.
Okay, very quickly, do you expect them to change their inflation forecast, Sonal?
In the April policy, I think we are broadly in line with the projections laid out in February, so not at the April policy.
Okay. Same question to you. Do you expect them, Samiran, to change the growth or inflation numbers? But more importantly, would you look for signs whether the RBI will, the MPC will stick to that 4% plus or minus 2, or would you look for them to not be so symmetrical and be comfortable with 4% plus 2? I mean, not too much mind if inflation is around 5.
So on your first question, I think all the risks that we are talking of, both on the growth side as well as the inflation side, there's so much imponderables there that it's too early for them to shift their inflation trajectory based on these factors. How much MSP hike will happen, how much will be the pass-through to market prices. These are pretty much open questions at this point of time. Similarly, on growth concerns, how much this banking slowdown is going to hit growth or how much trade slowdown is going to hit growth are all risks at this point, but difficult to quantify. So I suspect that the trajectories will not be changed too much. But the interesting point is about the response function to these trajectories, because when in February these trajectories were put in place, one would have wondered that with the projected trajectory staying more than 4% for such a long period of time, there should have been some action to bring it down to 4% almost immediately as a proactive measure. But since RBI did not do that, now with almost an unchanged trajectory, it will be difficult for them to take action till the point, if Sajjid is right, that the second half trajectory at some point of time needs to be upped, then there's a question of a response to that. But before that, it appears that they're going to use the 2% plus minus band on both sides quite symmetrically, the way RBI was not too keen to cut when inflation dropped to 2% or below also. Similarly, if it stays within that 4 to 6% range, there will not be too much of a pressure to hike. And as Sonal was also mentioning, that they're looking at some kind of a core number, which is still staying between 4 to 4.5, which would give them some comfort that this is not a runaway inflation.
Okay. Sajjid, since you were worried about several inflation-inducing factors, are you expecting a change in their trajectory? And do you think that you would look for this tone of sounding comfortable with a 4% plus inflation for the foreseeable future?
I think the second question is easier to answer. If you look at the minutes of the last meeting, it was very clear that the RBI said 12 months ahead, if inflation is meaningfully above 4%, that would perhaps trigger a change in stance. Now, what that meaningful number is it? Is it 4.8? Is it 5%? So I'm not sure that, at inflation down the road, close to 5%, this MPC in its infant stages of inflationary regime would be very comfortable. I think once we get close to 5% on a sustainable basis, not for 1 or 2 months, but if for 2 or 3 quarters, the inflation projections forecast inflation being close to 5%, then I think that would warrant a change in tone, a change in stance.
Are you expecting one in 2018?
I think, Lata, a lot will depend on, because these are all risks, how much of these risks become part of the baseline. Remember, in February, what the MPC said is they're still assuming oil at 55, and they're still not going with any extraordinary MSP increases in the inflation forecast. Is there sufficient information between February and April for some part of that to go into the baseline? If the answer is yes, I think the second half inflation trajectory changes to the upside. If the answer is there's still too much uncertainty, maybe we have to wait for another review.
Okay. Well, clearly the MPC is going through one of its more difficult phases where inflation is likely to rise because of crude, as well growth is likely to disappoint. So it's not a very...
Can I just take 10 seconds? I think this is what happens when you get these, what I call adverse supply shocks, because a mandated increase in MSPs, higher oil prices and global trade wars are adverse supply shocks. Both things happen at the same time. Growth abates and prices go up, and monetary policy making is never easy given that combination of circumstances.
Yes. I guess any monetary policy committee member will agree that this is a sticky situation when there can be upward pressures to inflation and can be downward pressures to growth. Gentlemen and lady, it's time to vote. Please pick up your voting boards. And the first question to you is, what should the action be? Should it be a pause or hold, if you please? Should it be a hike? Should it be a cut? Let me start with Soumya. Soumya, what would you vote?
Okay, there's a pause in this policy.
All right. Well, let me come to Samiran. Pause as well. Okay. Sajjid. Sajjid says pause as well. It's a hold. Let me go to the lady before I come to the chairman. Sonal. All right. Pause.
Pause.
Yes. Chairman, sir. Hold. All right. The committee is unanimous that no action. But can the MPC do something with its tone, with the tone of the statement? Again, let me start with Soumya. What would you expect the tone will be? Neutral, dovish?
I expect to be neutral to a cautious statement.
Okay, so more on the hawkish side, cautious. I would take it that way. Samiran, just neutral. You're not giving it any adjective. Hawkish or dovish. All right. As neutral can get. Your vote, your expectation?
It's neutral to cautious.
Neutral to cautious. So, okay, not expecting too much dovishness. Sonal?
Cautious.
I should expect that from you. That was your argument as well. Chairman, sir, would you expect that the MPC should or could sound a little dovish? Okay, cautious on growth. That's important, sir. So the chairman chooses to differ when it comes to the tone. He wants it to be cautious on growth and take that on board. But the four other members expect it to be either neutral or maybe slightly cautious. Thank you very much, members of the Monetary Policy Committee, for what has been a very enriching discussion.